Hello and welcome everyone. In this video, we're going to continue our discussion on depreciation methods, and in this video we're going to be talking about declining balance depreciation. And the main characteristics of this method is that a constant percentage, P, is depreciated yearly over the asset's life. So unlike the straight line method, which was a constant amount, this is a constant percentage. And we call this constant percentage P, and the way that depreciation would look like on a graph is shown here. And you can see that the depreciation in the early years are more, and then as you get closer to the end of life, the depreciation amounts become less. So it's called an accelerated write-off of assets because the rate of depreciation is accelerated compared to the straight line method. The way that we can calculate book value at any time is a cost basis times 1 minus P, which is the percentage, to the power of T. And if you were to calculate depreciation deduction at any year, D sub T is a P times the book value of the previous year. But now if we replace the book value of the previous year with its formula, we get to this final formula to calculate depreciation at any year, which is a function of the percentage and cost basis and T, which is the current year you're calculating the depreciation deduction for. But as you notice, the main important parameter here is the P, the constant percentage that we're going to use for this depreciation. There are two commonly used depreciation rates. One is 150%, the other is 200% of the straight line method. And the way that you can calculate these depreciations is either 1.5 divided by n or 2 divided by n. Remember that n is the depreciable life. The 200% is also called double declining balance. And the reason for that is that it depreciates an asset twice as fast as the straight line rate. And that's what's called double declining balance. So let's take a look at one example to put everything in perspective. And this example is the same example that we had for the straight line method. It says a surface mount placement machine is purchased for $98,000. It has an estimated useful life of 7 years and a salvage value of $7,000. Determine the depreciation deduction for the 5th year and the book value at the end of 5th year using 150% declining balance depreciation. So let's go back to the formulas that we had. We can calculate the depreciation deduction using this formula. In this case, P will be 1.5 divided by N, which in this case is 7 years. Cost basis is the $98,000. And T is the 5th year, so it's 5. So let's go ahead and calculate that. So it turns out the depreciation deduction for year 5 is $803. And that depreciation deduction using the straight line method, if you remember, used to be $13,000. And you can see that using the declining balance, it's less. And the reason is we're getting closer to the end of the life, and you remember the depreciations toward the end of life is less than depreciation using the straight line method. We also want to calculate the book value at the end of year 5, and again we can calculate that using this formula, cost basis and the percentage, and we know the T. We can easily calculate the book value at the end of year 5. And that book value is equal to $29,346. And comparing that with the straight line method, you can see that book value is smaller. And that means in 5 years we were able to depreciate more using this method compared to the straight line method. And if you want to put this in perspective graphically, we started from $98,000 cost basis, and the declining balance had this curvy shape where at the end of year 5, we were at $29,346 book value, and the entire depreciable life was 7 years, where at the end of year 7, the value is $7,000. So you can clearly see that there's a difference between these two depreciation methods. If I want to put them in perspective compared to each other, in this graph, you can see that the straight line method depreciates from 98,000, and the 150% declining balance also depreciates from the same place, but the depreciations are different and the book values are different. But there's a very important point here, and that is, it seems like at this point, if we switch from the declining balance to the straight line method, we're able to depreciate our assets further. If there was such an option for the taxpayer, in this case corporate taxpayer, they would do that because they can depreciate their asset further, meaning that they can reduce their taxable income further and pay less taxes. So there's a benefit in switching from declining balance to a straight line method here. And that's going to be the premise of our next video.